These 4 commercial real estate trends will define the next 12 months. Ignore them at your own risk. I'm Brandon Michaels. I've sold billions in commercial real estate, and I've helped hundreds of property owners achieve their specific goals. Commercial real estate in 2025 isn't collapsing, it's evolving. Here are the 4 trends that you need to be aware of moving forward.
Oh goody, that's so fucking trendy, right?
Number 1, cap rates have reset, and they're not coming back down. The era of sub 5% cap rates is over. Not just temporarily, but structurally. With interest rates higher for longer, risk premiums have widened, and investors are demanding better yield to justify acquisitions. What are we seeing? Core retail and industrial are now trading in the 6 to 7% plus range. Office and value-add assets, often 8 to 10% or higher. Best-in-class assets are being discounted if they don't come with strong credit, long-term tenancy, and clean exit visibility. The takeaway? Until the Fed cuts rates significantly and credit markets loosen, cap rates aren't compressing. They're stabilizing at higher levels. And that means your pricing, your underwriting, and your entire investment thesis needs to adjust. Number 2, operating expenses are on the rise. Net operating income is getting squeezed, not because of rent drops alone, but because the cost to run properties is climbing fast. Even stabilized assets are producing weaker cash flow as expenses outpace revenue growth. Here's what we're seeing. Insurance premiums are up 30 to 80% in some markets, especially in the coastal states. Property taxes are reassessed at higher values, even when market values decline. Labor costs for maintenance, security, management are up and sticky. Repairs, materials, and utilities have all inflated post-COVID and have not reverted. The takeaway: buyers aren't accepting surface level financials anymore. They're dissecting every expense line item and discounting deals where the NOI can't hold up under pressure. If your numbers aren't transparent, current, and defensible, your deal won't trade. Number 3, rents are softening and downtime is getting longer. Even in healthy markets, the momentum behind rent growth is slowing or reversing. At the same time, vacant space is taking longer to lease, meaning landlords are eating more downtime and offering heavier concessions to secure tenants. Here's what we're seeing. Leasing velocity has slowed, particularly in office, suburban retail, and older multifamily. Concessions such as free rent and TI packages are growing, though often quietly. Renewals are flattening or coming in below prior rents, and lease-up timelines that once took 60 to 90 days now stretch to 6+ months in submarkets. So what's the takeaway? A softening rental market is directly impacting NOI, not just through lower effective rents, but through longer lease-up timelines and deeper concessions. What used to take 60 days to lease might now take 6 months. Buyers are adjusting for the delay, and if your underwriting doesn't reflect today's rental reality and downtime risk, your valuation won't hold up. Number 4, capital markets are tightening.
Tight, yeah!
The days of cheap, abundant debt are behind us. Lenders are cautious, underwriting is conservative, and the cost of capital is reshaping what buyers can afford and what sellers can expect. Here's what we're seeing right now. Interest rates remain elevated with limited signs of near-term cuts. Loan proceeds are lower, driven by tighter debt coverage ratios and loan-to-value requirements. Lenders are focused on tenancy strength and exit clarity, not just cash flow. And bridge debt is expensive and harder to source, limiting reposition plays. The takeaway? Lenders are tightening their criteria in response to broader market risk, requiring stronger tenancy, lower leverage, and cleaner exit strategies. That's shrinking the buyer pool and limiting what can be financed. As a result, pricing is being forced down and more deals are stalling or falling apart. In today's market, debt isn't just a tool, it's a gatekeeper to transaction volume.